Hello, everyone. Welcome to our event. We thank you for taking the time on a busy day to join us, and we're looking forward to this great event. We're going to give it a couple of seconds to let everyone kind of tune in. As we wait, let me introduce myself and the speakers for today. My name is Lluncor with New World Mortgage, a division of American Pacific Mortgage. I have been in the industry for 21 years serving the Southeast LA community. And it is my pleasure to bring this event to you as I'm a big advocate on lending and our communities, and of course with special products. And this is why we have our great speakers from Freddie Mac, which will I be introducing. So just, as we get started, thank you everyone for joining us. We are gonna be very respectful with your time and making sure that we end the event on time. We will answer some questions at the end of the event, so feel free as we present our speakers and our speakers do the presentation to ask any questions through our chat, and we'll make sure that we answer every single one of them. If we don't have the opportunity to answer your question, we'll make sure that we will get back to you via email and make sure that you get the information you need, okay? So it's 10:04 now. We're gonna go ahead and start. Our speakers for today, as we invited them, we have Len Kiefer, Deputy Chief Economist of Freddie Mac, joining us today. He was going to be our first speaker, and our second speaker will be Bill Lowman, CEO of American Pacific, who are going to share valuable information of what happened in our industry in 2020 and what's ahead of us for 2021. So with further say, Len will be our first speaker. So Len, feel free to take away. Thank you very much for joining us. It's a pleasure to have you.
Hey, it's great to be here. Thanks so much. Great to be here to talk to you a little bit about what we see going on in the economy, housing, and mortgage market. I'm Deputy Chief Economist at Freddie Mac, working in our Economic and Housing Research Group, where we try to help people understand what's going on, in the economy, housing, mortgage space. It has been an eventful year or so in the economy and the world for sure. We're a couple weeks here into January, but a lot of eyes to the future to think about, okay, we had a pretty eventful 2020. What is going to be in store for us here in 2021? In fact, just today we published our Q1 outlook, sort of how we see things evolving. So I'm here to share with you, fresh off the presses, sort of our latest thinking analysis around that, our perspective on where we see the market headed. We had a very solid year for the housing market, despite enormous challenges for the broader economy. The U.S. housing market, especially on the single-family owned side, had tremendous rebound in the second half of the year. And so a key question for folks that I talk to is, okay, is this going to be sustain itself? Well, what are we going to see as we get into 2021? What we'll have in store for us? 2020 certainly taught us that there can certainly be surprises. And as a professional forecaster, I've done this economic forecasting for a number of years. We certainly learn that you're going to be surprised, but we try our best to try to figure out what we see as the key trends. We've done a lot of research and analysis to try to help understand what are the key drivers, and there are some themes, some very important themes that I think are going to continue to emerge and continue to drive housing market activity into 2021 and even beyond. And of course, as we are still continuing to deal with the COVID-19 pandemic and the associated economic fallout, is also going to be a major driver. And those two forces are coming together to really inform our outlook. So what I want to do, my plan is to share a little bit about just the economy, just because you got to think about where the broad economy is before you can really understand what you expect the housing market to be, but then bring it to the housing market and particularly thinking about mortgage interest rates, one of the key drivers of housing market activity. We've had record low rates. Things have started to move a little bit higher. What do we make of that? And then taking it one step further to look at sort of home prices, home sales activity, a little bit of our thinking about what to expect to see. We saw the housing market really heat up in the second half, particularly in the fourth quarter of 2020. Indications are at the start of this year, we're still continuing some of that momentum, But as you have a challenging economic circumstances, certainly you have interest rates maybe moving higher. What's that going to be, and what are things we watch out for, particularly as we think about those Southern California markets, which may be a little bit different than sort of things we see nationally. So that's the game plan. I'll be around later to take questions, but I'll give you a sort of a high level overview so we can take it from the top. I've got a couple of pictures just to sort of frame things, and I want to start off by thinking about the broader economy. And just where we have come over the last 12 months. So the latest data from the U.S. Labor Department was for the U.S. Labor Report on last Friday, was through December. And if you look at sort of where the economy is relative to where we were just in February of 2020, before the COVID-19 pandemic really walloped the economy, we are in a still difficult situation. Overall payroll employment, non-farm payrolls, the high headline number that you often see, is down about 9.8 million from where we were in February. So this is the chart that you see, and if you see in the screen here, is looking at cumulative job growth in expansions and recessions. So you say up through February of 2020, the U.S. economy had added 21 million jobs since the end of the Great Recession. Right, so there's that sort of long march upward. We were having pretty solid job growth. The economy was doing pretty well, and then of course we got hit by the pandemic. You see this enormous shock. We lost over 20 million jobs in just a couple of months, which is unprecedented. The Great Recession, which ended back in June '09, over that period we only lost about 7 million jobs. So about 3 times as many job losses as we saw in the Great Recession, which for folks that were looking at the economy and thinking about how things were evolving, I thought that was going to be by far the worst economic cycle we would ever see in my lifetime. Certainly was heading in. You look at the 2001 recession, only lost about 1.6 million jobs. The 1990 recession, 1.3 million jobs or so. So that was a big shock. But now you look at sort of where we are today, even with all of the strong recovery. Pretty solid job growth up until December. We had a little bit of a pullback there. But even with the pretty solid bounce back, still worse in terms of job losses than anything we saw in the worst of the Great Recession. That was a really tough economy. And things are really bifurcated. It's really hit different segments of the economy. It's not been equal. Some stats that I saw, some Fed Reserve officials looking at the labor market, thinking about sort of the highest income earners, sort of their unemployment situation is basically back to pre-recession levels, while many of the folks at the bottom of the income distribution are struggling with something maybe as high as a 20% unemployment rate. So there are enormous challenges for the economy, but it looks like we are on a road to recovery. We're hopeful that the vaccine will be successful. There's been some good news on that, and that will allow businesses to open, and that we will see the economy continue to mend. But it's going to be a tough road. This first 10 million jobs were relatively easy. There was a lot of firms that were temporarily shut down. The next leg of this recovery, as we get into 2021, is likely going to be tough. Yet despite those enormous challenges, the housing market has done really well. Part of that has to do with the unequal nature of the recovery. Sort of the sectors that got hit hardest tend to be groups of workers that on average have a little bit lower home ownership rate. So it's affected rental markets a bit more than it has the owned market. But there's no doubt that the single family owned market has been a standout for the broader economy. Part of that is because you think about sort of people's demand for housing, which is already hot coming in to 2020, has really been accelerated because of the need for space. Folks are looking to get away from some of those dense urban areas because of the pandemic, and you also have some natural forces that we've done a lot of research on. This millennial generation, we're coming of an age where it already was starting to make sense for many of them to become home buyers, and so that has pushed the single family owned market to accelerate in the second half of 2020. But I think that key driver, which is really important for how we think about what we're going to expect in 2021, is mortgage interest rates. So this is Freddie Mac's survey my team runs at Freddie Mac. We go out and ask sort of what's the average interest rate on popular mortgage products. By far the most popular in the US is a 30-year fixed rate mortgage. That interest rate last week, January 7th, was about 2.65%, which is the lowest single week survey reading that we have ever had. In our survey, I'm showing you some 2010 in the slide, but it goes back to 1971. And I've talked to students of economic and housing mortgage history, whether or not prior to 1971, was there ever a mortgage interest rate as low as 2.65%? And almost certainly the answer is no. So the lowest recorded 30-year mortgage rate in human history was just last week. And that's on, the heels of several years of decline. In fact, we reached a peak back in 2018. The rates got almost up to 5% in our survey. And if folks have been in the industry for, a few years, or you remember what folks, bought houses a decade or 2 decades ago, a 5% mortgage interest rate was already incredibly low. But of the standards of the last decade, that was pretty high. And we saw the housing market slow in 2018 and into the early parts of 2019. But up through the start of the pandemic, that decline in mortgage interest rates was really helping the housing market to really show some strength. And if I go back a year ago, when I was talking about sort of the outlook and had not much knowledge about the COVID pandemic, certainly not how tough and challenging it would be, I was pretty optimistic about the course for the housing market, partially because of low mortgage rates and partially because of those millennials and other demographic forces, which we'll get into a little bit more. But then, of course, you have the pandemic and things got tripped up, but then the rates declined. So you see a little bit of volatility in 2020, where rates kind of blipped around. The Federal Reserve stepped in to help stabilize financial markets. Part of that was to buy mortgage bonds. That helped to lower mortgage interest rates. And that lower mortgage interest rates really boosted the housing market. Now, I don't have this week's survey because I had to put the slides together a little bit earlier, but this morning we released a survey and we were up to about 2.79% for the 30-year mortgage. So a pretty big step up in mortgage interest rates. And if you look at treasury markets, mortgage interest rates, at least in the short term, are moving quite a bit higher. So you think about risk to the outlook, what could be a big challenge could be rising interest rates. You go back to 2018 and we saw home sales and house price growth slow when interest rates rose up to that then, local high of about 5%. So that's a real concern and something that analysts and looking at the housing market have to be thinking about. And we've done some research and thinking about what that could look like. Don't think that mortgage interest rates are going to spike, certainly not up to 5%. That's far, far away from our forecast. We expect to see rates drift up a little bit. It'll depend on what happens with fiscal policy and inflation and things, but a mortgage interest rate closer to 3% might be closer to what we'd expect to see, but fairly flat for the next year or so. And that's going to provide, that's not going to add the extra benefit. You're not going to see falling rates. I mean, you could, but it's not our forecast. But the low rates, 2.5% to 3%, which is kind of the range we've been in, that's very, very low and going to support the housing market. It has a lot of other positive fundamentals that are supporting and boosting activity. If we look at another dimension of sort of how the housing market has responded, those low mortgage interest rates, strong demographic demand, that the desire for space has really supercharged home price growth, because housing supply, which has been a challenge for a number of years, was exceptionally stressed in 2020 because we saw mortgage interest rates drop, folks looking for space. The available homes for sale just became incredibly thin, and new construction, while it's ramping up, takes a while to come online. And so the effect is you have a lot of folks competing for a limited inventory, and that has just pushed up home prices. So the red line on here is annual 12-month percent change in Freddie Mac's house price index for the United States. And then as a comparison, I'm showing Los Angeles metro area, just to give you a sense of sort of how things stack up in LA, which normally is sort of ahead of the country, sort of higher growth and lower lows, is actually running a little bit below the US in the last parts of 2020. The latest data here is, I believe, through November. But that has price growth of around 10% a year, which is very, very fast. The highest we've seen since, the peak back in 2013. All right, so very, very strong growth. And in fact, if you look at the last quarter of 2020, so you annualize the growth rate, the trajectory we're on in the most recent data, and that growth rate is closer to 20% annualized rate over the last 3 months. California is very similar. Most of Southern California markets are showing that. So it's just a real burst higher in growth, right? You see a little bit of a wiggle in early 2020 and then just like rocketing up. Well, that's because of low mortgage interest rates and really, really strong demand and really, really weak supply. That's not all pandemic driven. This is a chronic problem that's faced the US housing market for a number of years. We've done a lot of research to look at sort of longer term drivers of supply and demand in the housing market. On the demand side, you have the millennial generation who is increasingly looking to home ownership. They're providing a lot of first-time buyers. First-time home buyer shares are way up in our data and other data that tracks the mortgage market. That's really providing a lot of solid demand. You see that in home sales and the housing market indicators there. On the other side, supply is just extremely limited, not just existing supply, right? Folks that are listing homes, but also new construction. New housing construction levels have run well below what our population needs. So if you think about sort of the fundamental challenge for the housing market beyond, of course, COVID, right? That's a major economic challenge for this year. It's the low housing supply. And it's not an easy fix. You know, there are a lot of things that folks are thinking about, trying to figure out, well, what can we do to help supply and provide more housing? I know that Freddie Mac has been very actively thinking about it, from our senior leadership on down through many of my, very smart, great colleagues that are trying to think of what are ways that we can help bring more desperately needed supply into the housing market. We've got a couple of products like Choice Homes and Choice Renovation that can help either, get folks into homes or help provide, refurbishing of existing housing stock, which is incredibly important. So we have an aging housing stock. One way is to rehabilitate existing homes. Another way is to create new homes, new construction, rehab. All of that is needed. We need all of that to sort of bring new supply in line with very, very solid demands. And if you continue to see, this pandemic-driven shift of preferences, folks looking for more space, that's just going to create more fuel and create more push on that. And as long as we have sort of lack of supply, you're going to continue to see price growth running very hot. Now, if I look at this, I get a little concerned about sort of the trajectory of prices, because the history of real estate, right, is that you see these very, very strong run-ups in prices and it potentially could correct. Now, that's not where we're at. Certainly today, you look at sort of the price growth we're at now is not quite nearly as high as the 30% annualized rate we saw back in 2004 or 5. But that trajectory is something that analysts and sort of risk managers are going to have to think about and think about what happens if interest rates rise, what happens if the economy slips up a little bit. But in the short term, probably going to be a lot of momentum in housing markets. And so you think about folks that are looking to buy homes, the folks that think maybe I should wait. That's a risky proposition, because if you think about, well, mortgage interest rates have been moving higher, supply continues to remain limited, there's a challenge from affordability is probably going to get tougher going forward. Again, that's why we're going to need the types of products and services that sort of help speak to that tremendous demand, tremendous business opportunity out there, but challenges as well. That's kind of a whirlwind tour, a lot of research I've spoken about. Happy to explore more in Q&A if it comes to that, but I want to sort of just kind of get it to you short and sweet. We've got a ton of more information available. You can check out our website, Freddie Mac. We publish, like, for example, our forecast today. We have house price information, mortgage rates, other research that we do around sort of these longer term drivers. You can follow us on social media. I like to post charts and figures on LinkedIn, for example. Connect with me there if you want to sort of find out more, lots of more data and information. But for now, I'll just pause there and turn it back over to our hosts.
Thank you, Len. That's wonderful, great information. A lot to sink in, especially now in our industry with all the changes that are occurring on a daily basis. We are constantly, just looking for something new. We're always looking for something fresh. And like you mentioned, Choice Homes and Choice Renovations are some great products out there available for a first-time buyer. As 2021 approaches with us, we're still going to be facing the short of inventory. So knowing products and getting to understand everything that's available to us is going to be really important. So thank you very much for joining us. We will follow with any Q&A at the end. So thank you, just hanging tight. And now I am going to introduce to our CEO, Bill Lowman. I've been with American Pacific for 13 years, and I can't, I would take up a whole day just to express my gratitude and what a wonderful company it is to work for. And it is my pleasure to introduce Bill Lowman, our CEO of American Pacific. Bill.
Thank you, Luz. And first thing I want to do is, I know we have a lot of our Southern California friends here, Los Angeles area friends here that are attending this webinar, and I just want to send you, my thoughts and prayers. I'm up in Northern California. We We see what's going on in Southern California. And I just, your families, your community, to be safe and healthy. It's really impacting the Los Angeles area now. So I wanted to express that. Thank you, Len. That was awesome. I learned something every time. And as Len was talking, I was like, man, I hope I don't have anything in my presentation that counters what he said, because he's a hell of a lot smarter than me. So, but mostly I want to thank Luz for having the passion for home ownership and affordability and serving her community to drive this event. So thank you, Luz, for putting this on. And it's really an honor for me to come on and present today. To start out, I want to talk a little bit about American Pacific Mortgage, the company that Luz has been affiliated with for the last 13 years. So you have an idea of the company that she represents and that's standing behind her in her mortgage business. So American Pacific Mortgage, we call ourselves APM sometimes. We're a direct retail lender, and we are licensed in 49 states. And in 2020, we closed over $22 billion in loan volume. And that puts us probably, give or take, in the top 15 of independent mortgage banks in the country. And you may ask yourself, why haven't I heard of American Pacific Mortgage, a top 15 lender in the country? And really, it's our model. It's because of branches like Luz's. It's because of branches like New World Mortgage. It is our business model to support branches like Luz, to give them the autonomy to brand in their community the best way that they feel that they can reach and impact their communities. And that's how Luz has chosen to brand herself. And we completely support that and New World Mortgage as part of our company and a division of American Pacific Mortgage. And we really feel that support and how someone like Luz and New World Mortgage can best reach consumers in their community, working directly with our realtor partners and borrowers firsthand, and having that firsthand knowledge, that's really more important to American Pacific Mortgage than having a recognizable name. We really encourage our branches to be active and entwined in the fabric of their communities. And that's why, maybe you've never heard of us, but you have heard certainly of New World Mortgage. Most of you, I think, are probably doing business with Luz right now. So, American Pacific, we're a mortgage bank. We provide loan products, tools, resources, services, not just to New Way Mortgage. We do it for about 200 branches throughout the United States. So that's who American Pacific Mortgage is. That's the company that Luz is a part of, and that helps support her business. The theme of today's event is about thriving and staying educated as we stay and move into 2021. And so I'm going to try to share with you a little bit about where we are as an industry and where we're going. And it's going to be interesting because I think in order to do that, I've got to spend some time on 2020, which really is the most eventful year in my, about a 35-year career that I've had. And, obviously 2020, COVID has had a profound impact, and it really continues to impact our industry in many ways. And, we heard Len talk about it earlier. One of the ways that's, where it's really impacting our industry is around unemployment. And, Len talked about, maybe certain sectors are doing really well. Other sectors are really getting hit hard, like leisure, airline, the restaurant industry. But really, when I think about the impact of employment or unemployment on our industry, it's more than just employment. It's when you look at the year and think about, based on the different shelter in place orders that have gone on in various municipalities and counties and states, it's that on again, off again employment status of a borrower. And think about that, because one of the things that you have to do in order to close a mortgage loan is verify employment. So, is this borrower employed? Are they employed in an industry where they're it's the likelihood of continued employment, is not good. How do you go through that? How do you do that? And again, this is where I think New World Mortgage really has an advantage in their marketplace. When the way we look at it, it's so important when trying to determine whether a borrower is qualified, whether a borrower is employed, whether the borrower is going to have, the likelihood of continued employment. I would rather, have a trusted local leader like the folks in New World Mortgage in our branch, helping us verify that employment, making sure that the borrower is employed and can qualify for this loan and can provide unique insight to help them get that loan. I would rather have that local leadership than some brat sitting in a call center in Detroit, Michigan, doing that and making those decisions for me. So the whole employment, unemployment, it's had an impact. It's been tricky. It's had a huge effect on the mortgage business in 2020. And that's clearly carrying into 2021, as we're seeing some of the cases in many markets throughout the country peaking right now, unfortunately. So that's had a huge impact on our industry and how you lend going forward in your community. And that really has led into another thing that has really had a big impact on the mortgage industry, and it's definitely related to employment or unemployment, and that is forbearance. Received a lot of publicity in 2020. It was a part of the CARES Act, and it also, in essence, it allowed a borrower to forego payments without proof of hardship. And so that scared the industry for a lot of reasons. It created a lot of volatility in the market. It created guidelines to tighten up. It created, different ways that our lenders wanted to verify employment. And it really created a little bit of chaos for a period of time when that rolled out and when the CARES Act went into effect. But as we went through 2020 and we turned the corner on 2021, the impact of the CARES Act and forbearance really was not as bad as the industry initially thought. And I'm not sure what, if any, projections there were around borrowers going into forbearance. I think that was why it created a bit of chaos, because nobody knew. We had never really had a situation like this before. But the percentage of borrowers going into forbearance in 2020 peaked at around or a little over 10%, which I think, as an industry, we're looking at that saying, not so bad. Currently, the industry is at about 5% of borrowers that are currently in forbearance. So a lot of borrowers that have gone in have worked their way out of it, and it's currently at 5%. And I think I'm going to one more time harken back to the advantages of having a local lender and local leadership working with borrowers in their community. I'm making sure we've got the right loan products and we're doing the right thing for the borrower by putting them in a loan. American Pacific Mortgage during this period of time had way lower than industry average forbearance. So today, the industry's at 5%. American Pacific Mortgage is at 1%. And out of all the loans that we've done in 2020 through New World Mortgage, there's only been 2 borrowers that have gone into forbearance. So that, again, local lender, trusted local leader, not just protecting the lender, but really working with the borrower and protecting the borrower and making sure the borrower is getting in the right loan at the right time. So I think that, is going to continue to impact the industry, the impact of forbearance, but it's certainly going to be far less than we initially thought when we came out with the CARES Act. I'll talk a little bit about interest rates as we go into 2021. I won't spend a lot of time on that because one, Len already covered it, and two, he already knows way more than me. So, but you know, and what we've heard him say and what I've seen from other industry forecasts is, you know, long term, it's going to be a fairly steady. And when I say long term, I'm talking about 2021 and, you know, in 2022. Let's just say the next 2 years. Short term, I think we're seeing a lot of volatility. Len talked about it before. I think he mentioned about a 14 or 15 basis point increase week over week on his interest rate forecast, going from 2.65 to 2.79%. And that's the short-term volatility that we'll probably see for the next couple of weeks that you typically see around, I guess I'd call it chaotic world events or chaotic events in the country, right? So we saw this type of volatility, you know, initially when the country was faced with the reality of COVID. We saw this kind of volatility when around the election. And I think, you know, between, you know, the events of last week through and maybe a little bit past inauguration, you're going to see that short-term volatility. But long-term, you know, over the next 2 years, steady, perhaps mild increases, you know, and I've seen industry forecasts really aligned with what Len said, where you see the 30-year fixed rate mortgage staying at or even below 3% for the next couple of years. And certainly interest rates at or near that range gives strong support to the housing market. So that's really positive news going into 2021. And that's really, you know, with low projected low interest rates, that's really good for affordability. It allows for more people to qualify for a mortgage. So that affects affordability, that affects first-time home buyers. And as we see this next wave or this current wave actually of millennials entering into, you know, the home buying ages, that this interest rate projection for 2021 and 2022 is really positive for the housing market. And because of all of these things, you know, the projection of purchase business for 2021 and 2022 is on the rise. So you'll see industry forecasts that are going to show, you know, the industry projecting less volume in 2021 than the previous year, 2020. So, but that's really the drop in volume is going to be around refinance business, which, you know, occupied about 68% of the business in 2020. And you're going to see what's projected anywhere between a 5 and 10% increase in purchase business for 2021. Again, I think that's great news for everybody on this webinar, and I think it's great for our economy. So, you know, as we go into, you know, 2021, the market the previous year has posed unique challenges that we've all had to work through, and some of the greatest challenges certainly that I've ever experienced. But, you know, at American Pacific Mortgage, we always try to turn that around. And with every unique challenge, there's unique opportunities. And I think that's why we're here today. That's why we've got over 100 people here today to talk or to learn more about what some of these unique opportunities are, or to make some connections that, you know, even, you know, after this event, you can have conversations and dialogue about how to explore these unique opportunities. You know, and I'm grateful for Freddie Mac that's on this call. And they, you know, one of the things that strikes me is I was hearing, you know, Lou's talk earlier. There are a lot of products and solutions that we have provided by Freddie Mac that already exist that can help support us in some of the unique challenges in 2021 and turn them into unique opportunities. And they're products that already exist that we can better leverage. You can ask or learn more about Home Possible, Borrow Smart, Choice Home, Choice Renovation, all of these different products that are offered today that really, I would say, are underutilized. And I think we've been so busy kind of drinking water out of a fire hose in 2020 that we haven't had a chance to stop, pause, and say, hey, what's out there that can help support our businesses in 2021? And a lot of these exist. But, as always, our work is not done. American Pacific Mortgage will continue to work with Freddie Mac, who's been a great partner, and they're very passionate about their mission of home ownership. And Freddie Mac has a duty to serve the underserved areas. And because of the strength of a company like American Pacific Mortgage that I shared with you earlier, Freddie Mac is always open to work together with American Pacific Mortgage to see if there's ways that we can provide unique solutions that can be brought to you and your real estate community, and to support, New World Mortgage. So I think I'm right up against my time limit, Luz. I want to thank everybody for joining this. Like Len, I'll be around for a little bit if there's any questions, and it's just been really an honor to have the opportunity to chat with you guys today. So thank you very much.
Thank you, Bill. That's great information. We really value, you and Len for giving us updates on the market. As you know, 2020 was a very roller coaster year for many of our partners in real estate. And in 2021, forecasting and getting some inside information from experts, it's really going to help us leverage what's coming next in our industry. And like you mentioned, and Len mentioned, Freddie Mac and American Pacific are here to serve those communities that are in need, right? And there's a lot of great products, like you mentioned, a couple of them, it's Home Possible, Home One. It's also a great product. And we have renovation products that I know that we have a great support team that's helping us get through those renovation loans that are much needed out in their industry, that we're going to continue to educate our community, throughout the year. We do have some questions. Let me go ahead for Len. One of the questions for Len is Freddie Mac offering any other products that are allowed to refurbish and rehabbing home loans?
I'm more of the economist. Hard for me to speak on the specifics of the products. I think I have some Freddie Mac guests. If I can pull in a pinch hitter here, it might be better able to speak on the specifics of the products. For me being an economist, harder for me to talk on those.
Okay. Well, so I guess what they're asking is a question about the products, and we do have renovation products that are, in part of our American Pacific that we're going to be talking about and also doing presentations in the future, which is going to be our Choice Homes and Choice Renovations, right? So next question with APMC, which it can be to me or to Bill, is do we have any outside of the box offerings for first-time buyers? With Freddie Mac, we do have great first-time buyers programs with 3% down, and that allows us to lend with a minimum down payment and a very low PMI. So that's a great product to definitely look into. And we've provided and pinned in our chat room some websites and links to and flyers as well for more information on that. Okay. My contact information will also be pinned in the chat room as well, and we'll send out information to everyone via email. Bill, this question might be for us at home office. This is about appraisals and inspections. How conservative are we? How are we forecasting the appraisals to come in the future with appraisers, with values increasing so high, so rapidly? Do we have any challenges? Do you foresee any challenges with the appraisal department?
Thank you, Luz. Thank you for asking me to unmute. I said a lot of great, valuable stuff while I was muted, which is what I was, sorry about that. What I was saying, Luz, is I think the biggest challenge that the industry has right now, and we're not immune to it, is the amount of appraisers that are out there where we can get an appraisal done in a timely manner. That's in many markets is pretty challenging. And I have not, or we have not experienced, at least to my knowledge, appraisals coming in overly conservative. But if we see home price appreciation going too much over that 10% that Len talked about earlier, then it does become a challenge because it's, prices are rising so rapidly that, the comps are stale, even though they're only 30 days old. We haven't quite seen that yet. Although, I'm not sure if you've seen any in your market, Luz, but overall, in general, for the country, we haven't seen, whether it's over aggressive appraisals or too conservative appraisals, we've been pretty good at just getting them done in a timely manner.
Yeah, that's definitely, it's been our challenge, and we'll continue to see that as, the market continues to increase and purchase, it's on a higher demand. So next question will be, let me see. Well, this is for Len. Why do you think values are below national index prices in LA?
Thank you. Yeah, so it's the growth in prices, not necessarily the level, right? Certainly, if you look at the level of home prices in Los Angeles Metro, they're going to be much higher than the U.S. national average. It's that the growth rate hasn't accelerated as much as nationally, which is unique. It doesn't normally happen. Usually, LA, California kind of leads the way on the housing cycle. I think part of it is the unique nature of this crisis and the fact that many of these sort of middle tier markets have seen very enormous growth. You look at Idaho, for example, is at, I think, a 40% annualized rate, 20% year over year growth rate in terms of house prices. So some of those smaller markets sort of in the orbit of California and those big Western markets are seeing enormous growth. You hear some people talk about Zoom towns, places where folks are in remote work. You see this influx of demand there. I think you're seeing that. So I definitely think LA is keeping pace. It's just that, some of those other markets are seeing enormous growth. And because they have such limited supply and this influx of demand, the prices just really, really take off.
Thank you. Okay, we have time for one more question. Last question is, I think we kind of answered the same one. It's about the appraisal inspection. So we are going to be respectful with everyone's time. Just wanted to thank everyone who attended and thank Bill, Len. Also a big thank you to Nogisi from my diversity team that has helped me bring this event together. And Nora Guerra from Affordable Lending Manager, Freddie Mac. She's a regional manager for the Southern California. I want to thank her for helping me put this great event together. Without them, this would not have been possible. So I know that they're behind the scenes, keeping an eye on what we do, and they're big advocates on reaching out to our community. And as you promised, as a community leader in your industry in Southern California, represent America Pacific, my job and my passion is to continue to educate all my realtor partners throughout the year. And this is why I've partnered up with Freddie Mac to continue these events throughout the next 11 months. And our next event will be based on credit, which is a challenge for many of our first-time buyers here, especially in our region. And the credit program, it's Freddie Mac's Credit Smart Educational Event. It's going to allow realtor partners to learn more about credit with the clients, and also educate our consumers on how they can partner up with us to help them fix their credit without having to go through a credit consultation company. So, big things up ahead. We really would love to see you join us in the upcoming events. And please reach out to any of us. We have pinned all our contact information in the chat room. We will also email all our information and products and flyers to everyone that attended the event. Any further questions in the future, feel free to contact us. And we just want to thank you for joining us and have a wonderful 2021. We are here to serve you and serve your community. Anything that we can do for you, please give us a call. Thank you once again. Thank you, Bill, Len. Thank you for having me.
Thank you.
Thanks, great. Thank you.